Welcome to This Explainer. Let's get right into it. Today, we're putting on our detective hats and jumping straight into the meticulous, frankly fascinating world of accounting. Now, I know, accounting and thrilling don't usually end up in the same sentence, right? But stick with me. At its absolute core, accounting is an intense investigation. It's a relentless pursuit for the absolute truth of a business's financial health. We're going to look at exactly how businesses track every single penny and prove their records are perfectly balanced. So, let's dive in.
Because think about it, how does a business actually prove its financial records aren't just, well, made up? If a company claims they made $1 million in profit or they have $500,000 sitting in the bank, how do they prove those numbers weren't just plucked out of thin air? Well, behind every clean, polished financial statement is a rigorous, mathematical lie detector test. The data has to flow flawlessly from the second a receipt changes hands all the way to the final balance sheet. Every transaction leaves a footprint. Today, we're going to track those footprints to catch any errors or even fraud that might be hiding in the numbers.
Here's the roadmap for our detective journey today. First, decoding the ledgers. Then, extracting the trial balance. Third, the purpose of trial balances. Fourth, when things go wrong. And finally, the infamous suspense account.
Okay, part 1, decoding the ledgers. Our investigation kicks off in our first suspect pool, the ledgers. Think of ledgers as these highly organized storage units where all a business's financial truths initially hide out. Before anything becomes a grand financial statement, it gets sorted and stored right here. And the way this data is categorized is actually beautifully simple. Once transactions are grabbed from original documents, invoices, receipts, they're summarized into different types of ledgers based on double-entry rules. We've got 3 main categories. First up is the sales ledger. This one is entirely dedicated to the personal accounts of people who owe the business money, the debtors. Next is the purchases ledger. This tracks the personal accounts of the suppliers the business owes money to, the creditors. So by keeping these separate, a business instantly knows exactly who owes them and who they owe. But what about literally everything else?
Well, that brings us to the general ledger, or as it's sometimes called, the nominal ledger. This is the master control room. It's the catch-all for anything that isn't tied to a specific debtor or creditor. It records the impersonal accounts. That includes real accounts, which track physical possessions and property like motor vehicles, buildings, stock. And it also holds nominal accounts, tracking your day-to-day expenses, incomes, and the owner's capital. If a business pays rent, buys a laptop, or earns some interest, boom, it goes right here into the general ledger. Moving on to part 2, extracting the trial balance.
So now that we know where the raw evidence is stashed, we hit the critical climax of our investigation. We have to pull all these separate ledgers together to see if their stories actually match up. This is what we call extracting the trial balance. To really get this extraction process, we need to trace the chronological journey of the data. The accounting cycle is strict. Step 1. We capture the source documents, like sales invoices and checks, and punch them into the books of original entry, also known as journals. Step 2, we use our double entry rules to post those journal entries into the ledgers we were just talking about. Remember, every debit has got to have a matching credit. And then step 3, we extract a trial balance. Extraction is just taking the final balanced off totals from every single ledger account, including the cash book, and listing them all in one central spot.
And here's the absolute key takeaway. Extraction summarizes the status of every single account at one specific moment in time. You're no longer looking at thousands of individual sales or individual purchases. You're looking at the final synthesized truth of the ledger. It's the ultimate moment of truth for all that tedious data entry. If the accounting equation, assets equals capital plus liabilities, was perfectly respected during all those individual postings, the extraction is going to prove it.
Which brings us to part 3, purpose of trial balances.
So we've extracted this massive list, but what is this ultimate detective tool actually meant to do? Well, the format of a trial balance is elegantly simple. You've got a column for the details, listing your capital, cash, sales, debtors, expenses, the whole shebang. And right next to them, you have your debit column and your credit column. Because of how the double entry system works, assets and expenses naturally carry a debit balance. Capital, liabilities, and revenue carry a credit balance. When you sum up the entire debit column and the entire credit column, those two bottom line totals absolutely must match. If they are exactly the same, congratulations, the trial balance is balanced. But why does this actually matter so much? Well, this simple little matching exercise prevents absolute catastrophic failures. First and foremost, it's instrumental for preparing the final financial statements, like the income statement and the statement of financial position. You simply can't build an accurate financial house on a crooked foundation. Second, it acts as the ultimate internal lie detector to check for errors and fraud.
It proves the arithmetic accuracy of everything recorded in those ledgers. If those two columns at the bottom don't match, you instantly know an error has been made somewhere down the line.
All right, part 4, when things go wrong.
Because as any seasoned detective will tell you, things rarely go perfectly according to plan. Sometimes the math just straight up refuses to cooperate. There are two very distinct types of accounting errors that can throw a massive wrench into our system. First, you've got the errors that scream out at us, the ones that directly affect the balancing of the trial balance. These happen when someone makes a simple arithmetic mistake in the ledgers, or they only partially record a transaction. You know, like debiting an asset but totally forgetting to credit the cash account. Or maybe they just forgot to bring a balance forward. When this happens, the trial balance totals won't match, and the alarm bells start ringing. On the flip side, we have the silent, hidden errors that actually do not affect the balancing of the trial balance. Maybe you entered a transaction as $500 instead of $50 on both the debit and credit sides, or maybe you debited the completely wrong expense account. The debits and credits will still magically match at a common amount, so the trial balance looks totally fine, but the actual underlying information is fundamentally flawed. These are the tricky ones that require some deep manual digging to uncover.
Finally, part 5, the suspense account.
Let's zoom in on those loud, screaming errors for a second. The ones where the trial balance absolutely refuses to balance. Picture this. You have a tight deadline, financial statements need to go out, but you are off by a few $1,000s. It brings up a really critical question. What happens when the debit and credit simply don't match? The rules of accounting say the final statements must balance. But if your trial balance is off, where does that unexplained difference actually go? You obviously can't just delete it, and you definitely can't just plug it into sales and pretend it never happened.
Enter the suspense account. You can think of this as a dramatic, temporary holding cell. When a trial balance fails to balance, a suspense account is opened strictly to take charge of the exact amount of that difference. It artificially forces the trial balance to balance, so the rest of the accounting process can temporarily move forward, all while keeping those unexplained rogue funds completely isolated. It keeps the accounting equation on life support while the accountants scramble to dig through the original ledgers to find that missing partial recording or arithmetic error.
And here is where things get really urgent. A suspense account isn't just some casual internal sticky note that you can ignore. If those errors aren't tracked down before the final financial statements are prepared, that suspense account balance literally gets included in the statement of financial position. If it's a debit balance, it sits right there on the asset side. If it's a credit balance, it shows up on the capital and liability side. Imagine presenting your company's official financial health to serious investors and having a giant, glaring line item that basically translates to unexplained mystery money. It just looms over the entire business as a huge red flag that the internal records are flawed.
Which brings us to the ultimate challenge. The ledgers, the extractions, the trial balance, they are all brilliantly structured tools designed to protect the absolute integrity of financial data. But when human error inevitably strikes, the suspense account starts a ticking clock. Will your structured principles and thorough investigation uncover the hidden truths before those errors are permanently cemented into the company's history? It's a real puzzle that requires focus, precision, and a relentless pursuit of balance. I hope this explainer has given you a newfound appreciation for the investigative side of accounting. Thanks so much for joining me today, and keep asking those great questions.